Good afternoon, everyone. I'll request all of the participants to keep their camera as well as audio feeds on mute as well as switched off to avoid any disturbance during the session. We'll be starting the session now. May I request all of the guest speakers to also switch on their video feed so that I can introduce them? Great. So we have Mr. Amey Sathe, Mr. Manish Karnavar, Mr. Chandraprakash Padiyar, and we are waiting for Mr. Niranjan Avasthi to switch on the camera feed. Niranjan, if you could switch on your camera feed.
Hi, this is Niranjan. Actually, I'm in a very low bandwidth area, so if I switch on the camera, I would, it'll be a risk that I would be thrown out of the conference. So,
Not a,
apologies for that.
not a problem, Niranjan. We'll stick to the audio feed. Good afternoon, everyone. Thank you very much for connecting to us today on our session titled Financial Pulse 2022. This is an Investor Connect initiative that we will be bringing to you every month, where we bring in the markets as well as the fund managers close to the investors. If you're wondering why Financial Pulse, our investors form the pulse of our organization and hence Financial Pulse 2022. I'll be introducing the list of the speakers today. We have 4 amazing speakers from the asset management companies that we work with, and all of their managed funds are held in your portfolios. Our first speaker is Mr. Amey Sathe, Senior Research Analyst and Fund Management, Tata Asset Management Company. Amey has over 15 years of industry experience. Amey Sathe is a fund manager for Tata Large Cap Fund and Tata Young Citizens Fund. He's also the assistant fund manager for Tata Banking and Financial Services Fund and Tata Equity PE Fund since 2018. Amey has been working with Tata AMC since 2015. He will be speaking to us on overall markets and state of the economy. Second speaker is Mr. Chandraprakash Padiyar, Senior Fund Manager, Tata AMC. Chandraprakash is popularly known as CP in his circles. Chandraprakash has over 21 years of experience in research and fund management. He began his career in equity research and analysis at UTI Mutual Fund, and he manages one of our favorite small cap funds, Tata Small Cap Fund. He will be speaking to us on small caps and the recent bloodbath which has battered the equity markets. Our third speaker is Mr. Manish, Head Product Communication at ICICI Prudential AMC. Manish has over 13 years of work experience and 11 years solely with ICICI Prudential AMC. He will be speaking to us on the power of asset allocation and fixed income instruments. Our fourth and the final speaker is Mr. Niranjan Avasthi, Head Product, Marketing and Digital Business, Edelweiss Asset Management Company. Niranjan has 13 years of work experience. He has been associated with Edelweiss since 2017 and has also worked with ICICI Prudential AMC, again as a Head Product Communication at Reliance Capital Asset Management and ICICI Securities and Sharekhan. He will be speaking to another one of our hot favorite topics, global investments. We'll be proceeding with the session in a question and answer format. So I already have some of the investor queries with me, which I will be presenting to the respective speaker. During the session, I'll request all participants to put in any queries that you will have in the chat box. And after the session is over, in the last 10 minutes, we'll be taking the rest of the investor queries. So my first question will be to you, Amey, on the overall markets and state of the economy. Amey, 2021 has been a dream run for overall markets. We've seen the Indian markets beating not just the Asian peers, but most developed economies today. The Indian equity markets, what are we expecting from the Indian equity markets in 2022? And what are the drivers which have been the rally of, which have met the rally in 2021?
Yeah, hi. Good morning to everyone, and thanks for joining. Just a few things on what drove the economy. So, in fact, the outlook for the economy is actually better compared to pre-COVID time. And it might sound a little strange, but that is a fact. And we have been a little bit lucky because of COVID. Digital became a sort of a buzzword and becomes a necessity for everyone, and that helped our IT industry in a big way. So that was one reason that IT sector started doing well. And IT employs a lot of people, and they have a lot of spending power. So that has a quite a big impact on overall economy. Coupled with that China plus strategy, and that also resulted in our exports doing well. So that also sort of drove a lot of improvement in economy. So you talk to any textile player or tile manufacturer, anyone, you can clearly see the kind of growth numbers that they're doing is quite amazing. In fact, for the 9 months, we did around 300 billion kind of exports, so which is a quite a big number. Second reason for economy to do well has been the real estate doing well, and real estate is a very important element of the economy, simply because real estate involves consumption of whatever steel, cement. Once the house are constructed, you have paints, consumer durables. So it's a very important sort of component of the economy. And if you look at any economy in the world over last 50 years, whenever real estate has done well, you have always seen that economy doing reasonably well. So that was also second factor that resulted in economy sort of picking up well. And two more factors which are sort of not that visible, but one is government spending has been quite strong, and the second one is the resolution of large NPL. So economy was actually going through a lot of asset quality problems till 2018-19, and after that, what we saw was a lot of big projects which became NPL and which were stuck and doing absolutely nothing were resolved, taken over by the stronger players, and that sort of started moving the wheels of the economy. So these are the 4 or 5 factors which sort of help the economy. Having said that, there are still a few challenges. So bottom of the pyramid segment is struggling big time. Their incomes have been hit very badly, and expenses. You would look at the inflation numbers, and inflation hurts the most for the poor. If you look at, so that is also sort of have taken a toll. So hopefully, and that is visible in terms of two-wheeler sales or even microfinance loans, NPL. So that segment is I think needs a lot of help and a lot of support. I think government should give, at least through budgetary expectation. So that is a one sort of a issue that is still there. And in terms of valuation, now obviously we are at a premium. In fact, Indian market has fallen, but vis-a-vis even global markets have also fallen more. So technically, if you look at, we are at premium. So there will be some bit of a time correction one can expect. And also we are entering a relatively higher base effect, considering last year entire demand came in the second half of the FY20, and now we are entering a phase where demand is sort of evenly spread in this year FY21. So the base effect will be there. So I think so our expectation is that I don't think we cannot expect similar kind of returns that we saw last year, but moderate expectation, say around 7.5% of real GDP growth, add 4% of say inflation, 4.5-5%, and about 1 to 2% extra. So around 13-14% kind of a growth we can returns that we can expect say over next 2 to 3 years. So that is our broad expectation. You're on mute.
Thank you, Amey. So you made some great points over there. We talked about the IT, real estate, and government exports being the drivers of the rally in 2021. And we are not likely to see the double digit, at least the high returns that we saw in 2021. And the valuations are pretty strong. Now, moving on to our second question on the recent bloodbath, which has battered the equity markets. And this last week also saw one day where we had a 1,500 points correction. So my second question will be to you, CP. Markets have corrected by almost 10% from a high of 62,000 to 57,000 as we speak. And the biggest correction was 1,500 points in one day. What are the primary reasons for this bloodbath?
Well, thank you, Shalini, for having me on this session, and good afternoon to all the investors attending the session. So I would say it's still not a bloodbath. So I would say that these are normal corrections within the year. In fact, I was looking at the data before coming to the session, and last 1 month, the market is, or Nifty Sensex is down hardly 2%. So intra-month, the markets shot up and then corrected by in the last couple of weeks have corrected by 6-7%. But let's say in 3 months the market is down by 4%. So maybe you can say that over a 3 month period we are down 4%. But if you look at 6 months, 1 year, we are still very healthy, 20% plus higher from an index level. As Amey was highlighting on the state of the economy, positivity and earning growth for corporates and exports outlook and investment cycle, all of those things mean that ultimately I've realized one thing in my career is that the most important thing for us as investors to track is whether companies are able to grow profits or not. If they can sustainably grow profits at a healthy pace, then returns will follow. In between, there will be periods where there will be corrections. For example, right now, so let me take your question first, just to kind of highlight that today or in the last 1 year, as Amey was also highlighting, digital or IT businesses, uh, both globally and in India, because they were in the spotlight. People were kind of focusing on those companies, new age companies. Even in our market, there are a lot of new age companies which have got listed: Zomato, Paytm, Policy Bazaar, Star, or so many companies. Now, what has happened is that there was so much of focus on or skewness of kind of money flowing toward that particular sector, that valuations got re-rated very, very sharply. So in our, when we look at businesses, for example, for investments, we look at this term which is PEG, price to earning growth, which is that if let's say a company is growing at 20%, and if the valuation for that company is let's say 30 times, then your price to earning growth uh, is less than one. Uh, Typically, I would ideally want to have a company which is 1.5 plus uh, PEG, which means that the growth is higher than your PE valuation for the business. This is a very crude way of looking at things, but I'm just highlighting that for these IT businesses, many of them, especially mid-cap IT in India, certain businesses which don't make money, for example, a very large part of uh, the digital ecosystem in the world and in India still does not report profitability. They are growth businesses uh, in the hope that someday they'll report profit. They are trading on the markets. So what has happened is that so when you have such kind of an environment, whenever bond yields start rising, so in the US, for example, we are seeing bond yields have inched up a bit to something like 1.8%. Uh, and there is a fear that, and in fact, the US Fed is openly saying that we will now start raising rates in March onwards. So whenever yields start moving higher, or the anticipation of yields moving higher is there, and naturally valuations for, especially for businesses which don't generate profitability or don't generate cash flows, they first correct. And then if there is too much of, let's say, the PAG example that I was giving, wherever businesses are trading at very high valuations relative to their earning growth, they tend to be the first ones to correct more. So in this environment, what we're seeing is that is the phase where we are in today. We are seeing the correction in digital and IT businesses across the board. And I think it's a phase. We will get over this as well. And more important, as I said, is that is corporate earnings likely to grow at a healthy pace? My opinion, yes. I think in India, especially, corporate earnings are likely to grow at healthy double digits over the next 2-3 years at least, if not more. I think we are at an inflection point from an investment cycle perspective, which is capital expenditure from corporate India, including MNCs coming to India to set up shop. I think in that environment, it is, I would say I'm positive. I think earning growth will sustain at a healthy double digit pace, which means that, and I would concur with what Amey mentioned, I think 13 to 15% CAGR return for the markets is possible. I think so. We are in a good shape. Small corrections here and there will come. In fact, I would say that it's still a very, very small correction. Normally, in our markets, whenever we correct, it doesn't stop at 4%. It tends to be a 10-15% correction. So let's see. It will be a very healthy correction if we get a 10% correction. So I would not be very worried about that.
Thank you, CP. My second question is also towards you. So, does 2022 look like a consolidation phase for the equity markets? We saw many first time investors in the markets step in as they dreamt of making quick money. Although you're still talking about a 12, 13, 15% CAGR growth in terms of the investment returns. But what are the expectations going to be in 2022?
So difficult to give a view, especially for a 12-month period, because it can be lumpy. It tends to be lumpy in many times in terms of equity returns. Uh, However, the way I see things, and uh, I'm kind of giving a disclaimer before I give you my view, that it's extremely difficult to pinpoint short-term returns for the markets. I think it's not easy to do that, but still, I will hazard a guess, or I will find kind of looking at the circumstances. Let me highlight my views. I think last 12 months, uh, there were lots of supply chain disruptions globally. Freight cost moved up, production was impacted globally for various sectors, uh, and demand was stable. It was not growing fast, but demand was stable. So when demand was stable and production got impacted negatively, we suddenly and more importantly in the US, where a very large amount of stimulus was given to their population. 2021 was a year where a lot of free money was flowing around in the system, and that free money meant that goods demand in the US. If you look at the chart for the US goods demand, it shot up disproportionately higher. We were living in an environment where 2021, in a way, you can say that it was an unusual demand environment, especially in the US, which meant that exports to the US for all economies was very high, whereas imports, which is why there was this freight dislocation across the world. Uh, Inventories across the system, across sectors were very low. Where we are today, I think we are in a stage where demand continues to be stable. US is now from a very high demand is coming to normalized levels, and which is why we are now starting to see supply chain disruptions getting over, inventory levels moving higher. Uh, in a couple of months' time, my personal opinion is that inventory levels in most sectors or segments will normalize, which means that maybe second half of 2022 uh, will probably be a normal growth year. When I say normal, it would what I mean by that is that the U.S. economy growing at something like 2.5%. At this point in time, they are growing much faster. Uh, when that happens, when supply chain disruptions get over, freight rates normalize, they've already started normalizing, by the way. Uh, Commodity prices being in a range or normalizing as well, uh, barring there is no COVID disruption again. But I'm just saying, if you live in a normal world, uh, there are you should expect uh, a range bound market for some time. Having said this, so I agree with you. So your question that will we see a consolidation in the markets in 2022? I think yes. Having said this, uh, I see lots and lots of businesses, especially in Indian listed companies. I don't track US listed companies so much. My team does. We have a view, obviously, on them as well. But when I look at Indian businesses, uh, there is still a lot of scope for surprises for Indian companies from an earnings delivery perspective. So there is, so for example, when uh, the people generally track the Nifty as an example, as an exchange, or Sensex as an exchange, whenever we talk about the markets. But when you go below the Nifty Sensex, when you, let's say, track companies, which is where my small cap comes into the picture, when I track the 251st company and below from a market, so today, by the way, 251st company has a market cap of 16,000 crore. So between 1,000 crore and 16,000 crore market cap is small cap for me, for my Tata small cap fund, for example. And I'm just giving you an example. When I track those 700 plus companies that I have that are listed in the exchanges between 1,000 crore market cap and 16,000 crore market cap, I find lots and lots of potential for companies to surprise on earning growth on the upside, which people may not be tracking very well still. So, which is why I'm a bit optimistic still that if you choose your business well, if you can identify the right business with strong balance sheet, strong management teams, free cash generating companies, I think there is still room for valuation upsides, re-rating of valuations, and earning growth, which can deliver you returns. So, in a way, I would say that, and the last thing that I would highlight is that in the past 10, 12 years in our markets, we have seen skewness of earnings by one particular sector or a couple of sectors at one point in time. I think we are entering a phase where there will be a very broad based earning growth across sectors. And that is where it is, I would say it's an exciting market to choose stocks actually. We are entering a phase where if you can identify the right business, allocate it right, hold for the long term, I think there is decent returns to be made. 2022, yes, for first half, maybe we can see some consolidation in the markets. But choosing the right stock, if you are a bottom up stock picker, you can still do well. That's the way I would answer.
So thank you, CP. Some definite takeaways from there. In 2021, we saw a dream run. We saw that supply chain disruptions started happening. Inventory was low, which is starting to become positive now. But in the long run, if we are talking about picking up good companies, picking up exciting companies with sustainable growth, strong balance sheets, we are definitely looking at good long-term growth in the next 3 to 5 years. My next question, I'm going to circle back to Amey. Amey, the rally in 2021 was led by IT. You talked about IT, real estate, and government exports. The rally was equally run by industrials and metals. Which sectors do you think are going to be the stalwarts or highlighted sectors in 2022?
So our in-house view is that there are four sectors where we are a lot more comfortable. One on the banks, considering the valuation is pretty attractive, and this was the first quarter when we saw asset quality problems sort of getting over. So profitability improvement will be quite sharp for banks in 2022. Second sector that we are comfortable is large cap IT, considering the tailwinds in IT are quite strong, and relatively valuation is compared to what mid cap IT is. I think valuation in large cap IT is still quite reasonable. So that is the second sector where we are comfortable, or we are sort of overweight. Third, it is the industrial manufacturing and automation. I think that is another theme. I think is picking up quite well. And if you look at the order book of some of the MNC listed entities in India, like ABB, Siemens, they are showing quite healthy growth after probably 2 to 3 years of sharp slowdown. So that is another segment where we are a lot more comfortable. Valuations are expensive out there, but I think that has been always the case. But earning growth can surprise positively. And the last one is that where probably it is power sector is also one sector where we have a relatively higher weight. That is power, both generation as well as T&D. I think that is the one sector where I think India seems to have sort of underinvested in last 4 5 years after the kind of a deluge that we saw in power in 2011-12. I think last 4 5 years, I don't think we have added enough capacity, and with focus on EV and all, I think power consumption is likely to go up steadily. And clearly that is one sector where we think valuation is comfortable. I think it's pretty cheap in for some of the names, and earning growth can surprise positively. These are the four sectors where we are comfortable. I think clearly there are few sectors where the valuations are stretched. So there we might see some bit of a time correction. So consumer sector is where valuations are stretched. I think that is where probably we will see some bit of a healthy time correction in 2022.
Thanks, Amey. So, investors' key takeaways: banking, industrials, and power sectors. Comfortable valuations. We should be looking at these sectors in order to make money in the long run. I'm going to move on to a bit on the asset allocation and fixed income side. So, my question is to you, Manish. When investors see double digit returns coming across large caps, 57% we saw across small caps in the past 1 year, they often disregard other asset classes, especially the most aggressive investors. So, why don't you tell us about the power of asset allocation in our portfolios?
Yeah. Thank you, Shalini. Thank you, all the investors, for having me here. Um, yeah, I think so. What normally we say is that yeah, you're correct. When you're putting it across last 1 year, we have seen a phenomenal return in terms of equity, 50, 55%. You'll say any of the funds you pick, you would have bet you would have got a returns which is more than 35, 40%. Now, so that's what our very close view which we are looking at an equity market, right? So I'm just taking it slightly longer. If you look at in past, right, there were periods. So I'll just give you an example. When you look at 2008 global financial crisis, you would have seen market correcting much sharper. You would have seen March 2020 when actually the COVID hit. You would have seen market correcting by a negative 25%, right? Or let's say 2000, 2001 dot-com bubble, you have seen market correcting. So there were phases, right? When you're dealing with equity as an asset class, there are phases when you will have bouts of volatility, which the earlier speaker also highlighted, that you need to now moderate your return expectations. Whatever you have seen in the last 1, 2 years, you have to moderate, because equity as an asset class is a cyclical asset class, right? So there are times when the equity as an asset class has moved, the valuations has moved out. It's a good time you have to go back to your drawing board and look at what kind of an asset allocation you are having, how much you are invested in equity, how much you are invested in debt, how much you are invested in gold, etc., etc. Right? So every asset class. So gold, if you look at, I'm just giving an example. I'm just stretching here. Gold, if you look at, maybe after 2013 to till 2018, it has done nothing. If you look at real estate as an asset class, right? Real estate has not done nothing from 2013 to 2020. You would have got a return of CAGR of 0 to 2%. But I think 2020 was when you have seen even gold doing very well. And off late, you have started seeing real estate doing well. So my point over here is that why asset allocation becomes so important is that every asset class goes through a cycle, and so is true for equity also, which has given a great. So if you want to have a good long-term experience, if you are an investor who likes more of a consistent, predictable kind of a return, and if your goals are very nearby in the next 2, 3 years like that, then it's prudent that you should always focus on asset allocation also. So that let's say you have good exposure to equity, you have good exposure to debt, gold, etc., so that you have a much better journey while achieving your goals. So that's why asset allocation plays extremely important role when you're trying to achieve your goal. Shalini, back to you. Thank you.
Thank you, Manish. So, key takeaways from asset allocation: all asset classes are typically cyclical in their returns. So is equity. If you're looking at a long term tenure, always look at adding multiple asset classes, because there will be some time when equity will not perform well. That's the point of time when your other asset classes will do well for your portfolio and provide some stability to your portfolio. I'm going to move to small cap space. One of the hot favorite topics, a personal favorite of mine, as well as our investors. So, CP, my question to you will be, the BSE small cap index has grown by 57% in the past 1 year. How should retail investors approach?
are some of the thoughts that come when people think about small caps, uh, which is where I think 2018 was a turning point for small cap as a category, as a small cap fund as a category, because SEBI and AMFI, they started prescribing the definition of what is a large cap and what is a mid cap and what is a small cap, to align everybody in one go. And I remember, for example, we launched Tata Small Cap Fund in 2018 November, and at that time, the 251st company in our market used to have a market cap of 6,000 crore approximately. Today, that same 251st company in our market has a market cap of 16,000 crore. Now, in my earlier career period, in fact, I remember a time period between 2000, let's say 4 and right up to 2012 or 11 maybe, where we used to think about mid caps between 3 to 5,000 crore market cap. Uh, the the size of businesses have grown in India. Size of profitability, absolute profitability of for companies have grown, scaled, uh, and market caps are also reflecting that. Uh, and in fact, it's a good thing to highlight the Tata Small Cap Fund portfolio that I run today, and I've been running it for 3 years plus. I Since the day one that we started it, uh, majority of companies don't have any debt on the balance sheet. They are free cash generating companies, businesses sustaining growth at a very healthy double digit pace, and which is why I would want to first highlight that we are in a different era, a different environment when you think about small cap as a category. It's just that these are smaller businesses relative to the larger peers of theirs. Uh, the other thing that I want to highlight is that in the small cap category, most of manufacturing that happens in India today, a larger part maybe, is residing in the small cap category. It's just that between 2009 and 2017, 18, 19, let's say 19, let's say. So maybe right for 11, 12 years back to back, manufacturing in India was in a weak environment. GDP growth was slow, global growth was also slow, banking sector was not doing well in that time phase, real estate was not doing well, uh, and India anyways was not known for manufacturing. Uh, and Suddenly, with what we are seeing as an environment today changing from a China plus one, that's a term that we've started hearing more often now, and competitiveness in Indian companies itself has improved significantly, and government is taking measures to uh, ex- kind of enhance internal manufacturing plus exports out of India through production linked incentive schemes and all. uh, I think we are in a phase where manufacturing as a theme is one of the best theme to focus on for the next 5-10 years in India. And when you do that, small cap is the best category to own actually, because that's where a large part of manufacturing resides in India. In fact, in my portfolio, when I look at it, uh, close to 50% of the portfolio is all manufacturing, logistics, and companies which benefit from manufacturing activity in India. And increasingly, we are identifying more and more businesses which are likely to export more or grow more in Indian markets. Or it's a phase where I think. So coming to your question now, I think last year returns were very high, yes, 57%, but that was on a base of very low or negative returns for plenty of years, barring 2017 as a calendar year. So 2017 we saw a sharp rally, and then 18, 19 we saw a sharp reduction in the stock prices. The reason why that happened was that fundamentals were not supporting. Period between 17, 18, 19, there was hardly any earning growth for those businesses. So those businesses, the stock prices when they went up in 2017, they were going beyond fundamentals. So it was not sustainable. Today, earning growth is what is supporting that. 2021 was the first year after a very long period where earnings grew at a very fast pace. And I think this phase of higher earning growth, faster, 20% plus earning growth, in my opinion, at least for the next foreseeable future that I see, the next couple of years will continue. And as I was saying, 50% plus of my portfolio, I think, has room for re-rating as well from a valuation perspective. So valuations are also still reasonable. Not everything is cheap, but as I said, 50% plus is still reasonable. In my opinion, has room for re-rating as well, given this surprise element that I believe earnings will follow. So net, I would say there is good room. I think investors will. Uh, I think it's still a, as they say, picture abhi baki hai. It's still going to continue. I think we've probably not even reached the half trail intermission period. I think we are early days. Maybe in the next 3-5 years will continue to look good. The only challenge for small cap as a segment, and now I'm not only talking about my fund, but as a category, is that majority of the funds are growing in size. Uh, we are even my fund has now grown to 2,000 crore as size, though it's still manageable. But most small cap funds are growing, have grown to 5,000 crore or higher. In this category, liquidity is relatively lower from a stock perspective, stock trading perspective. So whenever there are drawdowns, whenever there are weak periods, you tend to see higher volatility. I don't think that nature will change. So if whenever you advise or your investors invest in a small cap fund, I think it would make sense to look at the longer term rather than and invest more maybe in a volatile period when things correct fast. That's the time to put more money maybe. But I can say I at least the next couple of years I think we are okay. I think one can expect healthy double-digit performance continuing.
So one simple key takeaway from there, we're still halfway there. Picture abhi
Not
baki hai.
even halfway actually.
Not even halfway. Stay put in the long run in small caps, definite money to be made. 2017-18, there was a sharp rally in small caps, sharp reductions without any backing in terms of the earnings growth. However, current situation is that while valuations are slightly stretched at about 50% of the stocks, but there is a strong backing for that. Earnings are definitely supportive of that. So look at corrections for investments in the small cap space and stay put over there. I'm going to ask you one more question on the small cap space. CP, there are more than 4,000 listed small cap stocks, although you are still looking at a smaller universe on our Indian bourses. Our investors would love to know the stock picking mechanism. And I know I'm going to ask you an industry secret. How do you pick up stocks from such a large space to deliver the astounding returns that you've given to our investors?
So, so as you rightly said, my universe is smaller. I don't look at all 4,000. Given the size of the fund as well, I prefer to focus between 1,000 and 16,000 crore market cap companies. And in that range, you have 700 plus companies, around 710 to be specific, actually. So we have a fairly large universe, by the way. 700 companies, I don't think any other fund category has to invest in. So you have a very large universe. So in this category, in small caps, uh, one is obviously you need to look at the business and potential of growth and can it sustain and can the company deliver high profits and all. That's certainly important. That's important for all categories of funds, whether it's large cap, mid cap, or small cap. You need to do your due diligence to identify the right business. Can it grow? Will it sustain? So those questions are common. Uh, but one thing that small cap needs to, a fund manager in small cap or an investor in small caps need to focus even more, and it's is the fact that you need to identify the right management team who is running the business or the right promoter who is running the business. Uh, it is very important to look at the behavior of those people who are running the business, historical track records, your comfort level with those people who are running the business. Do they believe in corporate governance practices? Uh, do they? What is the vision that they have for the long term? It all those things are extremely important because see in this category, for example, the reason I say this is that uh, suppose you get a market correction, a large, let's say a 15% general market correction, which is no common in India. Uh, Small caps will tend to correct more. Let's say they will correct 25%. Let's assume for one reason we get a year where we'll see a normal correction of 15% in the markets, and we see a 25% correction in small caps. At that time, if you are invested in the right people in those businesses, you will have conviction to hold on to those companies and you will buy more. And that is more important, in my opinion, than anything else. It's the most important thing. If you smaller the company, because these companies also tend to, one small thing that goes wrong in their business can tend to impact 2-3 years of their earnings. So they need, so which is why it is important to focus on the people behind the businesses, what they are doing, and then track them very closely. Once every month, once every quarter, you need to know what is happening in your business, how how it is panning out compared to long-term trajectory. So it's a hardcore, or it takes a full-time job. It is required that you focus a lot. It's a disciplined approach that is required in these businesses. But if you choose the right companies, you are compensated very, very well for that. So that's the trick actually. It's more philosophy that I'm giving you, but that's what you need to do.
But CB, for a common investor, and I've been asked this question, especially in the small cap space, how do you identify right promoters? How do you track these right promoters? In the large cap space, they are ruling the headlines. But how about the small cap space? How do you know whether the promoter is right or wrong in terms of governance?
Well, the which is where the experience of the fund manager and the team is very important. So Amey here, as you was saying, is 16 years plus in the markets. I've been here for 21 years plus in the markets. My other team members are all at least 15 years plus in the markets. So we've been meeting these promoters or management teams once every quarter at least for the last 15 plus years. So we know who behaves how, what is the value of something that somebody is saying. Do they actually deliver what they are saying? So experience is what matters. Yes, in small cap investing, especially, uh, you should. Uh, an analyst or a fund manager needs to have that much experience to identify that this person is saying the right thing or wrong thing, and then bet on that person also. So I would say it's the experience that matters more.
Great, experience matters. So investors, especially when it comes to the small cap space, do have confidence and faith on the advisor as well as the fund manager in selection of the right businesses for you. My next question is going to be on global investors, on global investments. So, Niranjan, this is targeted to you. Some of the stocks which have ruled headlines in terms of both industry as well as returns are Tesla, Microsoft, Amazon, Netflix. So, we have investors who are now looking at the negative or single digit returns in their portfolios and want to exit these global funds. And my recurring advice to them is that look, it's equity. You need to have patience for at least 3 years for any equity fund, whether it's domestic or whether it's global, to deliver returns. How would you speak to our investors on the lower, I would say, lower returns than what these global investments have delivered in the past? How would you suggest to the investors to stick with these funds? Niranjan? I think Niranjan has unfortunately left the conversation. Ravi, in case you're there, could you please have a check with Niranjan if he, in case he's still there? Ravi or Anurag, could you please check with Niranjan in case he's still there, and I'll request him to rejoin the conversation.
Sure, Shalini. I'm just rechecking with Niranjan.
Thanks, Ravi. Meanwhile, I'll move on to Manish once again. We were talking about asset allocation approach, and I would also want to address the fixed income side, which is equally important. So while equity investments give capital appreciation, fixed income instruments are also equally important to the portfolio for capital protection. Manish, debt mutual funds were able to beat inflation till a point of time. Till just about last year, we saw credit risk give us a 9% return as well. And they were able to beat inflation, they were able to beat fixed deposits. But now with increasing bond yields, we've reached a CAGR of about 6% even in credit risk instruments. So how do we continue to beat inflation, and how do I still manage a conservative approach for a conservative investor in the portfolio?
Yeah. Shani, I think the opening statement was bang on because what you mentioned that every asset class has its own role to play, right? When we talk about equity or when we would talk about small cap, mid cap, right? So the main objective for that particular asset class is to create wealth, creation of wealth, right? Debt or fixed income per se, we call the predominant role of fixed income as an asset class is to preserve your wealth, capital preservation. Because if you see debt, fixed income returns, if you take it, let's say a 5-year rolling or a 10-year rolling, in the last 10 years, if you look at the returns which would have been created for out of a short-term fund, average would be around 8.1 or 8.2. So there is a consistency which is there in fixed income, but yes, the returns would be slightly lower. You cannot compare it with equity. So the objective of fixed income is capital preservation. And today, when we are talking about asset allocation, it's very important. The role of fixed income is now becoming much, much more important because you are coming out of a last couple of years where you have seen equity doing extremely well. The returns are extremely, so most of the things are priced in into the equity markets. Maybe going forward, you might see some consolidation or returns might be there in the range bound kind of situation. So it's very important that you go back, which I have just highlighted in my opening statement, that go back and check your overall asset allocation. And if you are under invested on fixed income space, or like I say, if you are over invested on the equity space, it's good time that you shift that some extra money. Second point, which you have highlighted on the inflation part. So this is not only an Indian phenomenon, right? If you look at even globally, everybody is going through we call it a zone where the interest rates and the inflation, the return which you are holding a bond paper, you are having a negative yield, we call it. So for example, if I take the 10-year GSEC, 10-year US 10-year GSEC, right? It's around close to 1.75 or 1.8 in that range. And US inflation number, which just recently came out, is 7%. That is 40 years high. After a period of 40 years, we are seeing US inflation touching almost close to 7%. So there is a massive negative yield which investors making. Same is the case in India also, where you are seeing inflation somewhere in the 5.5% kind of a zone, and you will see a 1-year T-bill or a 3-year AAA or 1-year T-bill to be exact would be around 4.35 or 4.4. So there is a negative yield, yeah. But this is what happens normally. There would be period, we call it as financial repression or financial oppression, where you are garnering a negative return. But what we believe is that that's why RBI or central banks is there, so that if you are if the negative yields continues, that can hamper the overall economy. So that's why what we believe in the coming months or in the coming quarters, you will see RBI normalizing the liquidity conditions, normalizing their stance, and maybe in the coming months or coming quarters, you will see repo rate hikes also. All this is something which is pointed towards to ensure that inflation remains in check. Once inflation gets controlled, you will see fixed income portfolio or fixed income instruments again giving you a positive yield, which you have seen. But yeah, this is a phase where we are seeing a negative carry or negative yield over inflation, which is there. But I think RBI is there on the job, and in the coming months, you will see action to be taken so that inflation remains in control. Thank you.
Thank you, Manish. So on the fixed income side, two takeaways from there. One, in case, have a look at your portfolios in case you are looking at a very high alignment on equities or a lower alignment on debt side. This would be a good time to relook at the alignment part in the portfolio, have a more balanced approach. And secondly, inflation across the globe as well as in India is on a rising trend, which is why we are seeing a negative carry or a negative return from our debt instruments to the inflation. But RBI is working, it's managing multiple goals. And once the inflation corrects, inflation normalizes, we'll still see better returns on the debt and fixed income side. So Niranjan has unfortunately not joined in at the moment. Ravi, is Niranjan joining in? Do we have any update on that? Not at the moment. So Abhishek, you are there and you love to answer investor queries. So I'm going to put this question on the global funds to you. Abhishek, if you can switch on the camera feed.
Hi, Shalini.
Hi, Abhishek. So I want to speak to you on the global investment side. We've seen some global stocks, especially the tech space, give amazing returns in the past 1 year. We saw Tesla, Microsoft, Amazon, Netflix. These all these stocks ruled the headlines and gave amazing returns to our investors. But now in the tech space, we are seeing corrections, and a lot of investors approach me whether we should be looking at exiting these funds at the moment. And my advice to them is that you should be looking at these funds from a long-term perspective, because it's equity after all, and equity is going to be volatile on the short term, on the short run. So why don't you advise our investors on how to approach these existing global investments in their portfolios?
Yeah, thanks, Shalini, for the question. And Shalini, we all know that 2020, because of the pandemic, we got a lot of these IT companies going up because dependence of IT increased, and moreover, the IT model can work on work to home basis, right? Something like a manufacturing probably cannot, something like an export probably cannot, but IT as a basic function can support work from home. So you saw in that period that some of the companies gave good earning returns as well. And also people, because of the excess liquidity which was there because of the Fed stimulus, people and investors across the globe invested a lot in these IT companies. Over a period of time, they gave phenomenal return, and the time correction is bound to happen in the technology space as well. And I think CP pointed out rightly that in this space, a lot of times what happened is companies which are not that much on profitability growth also increased due to this rally happening. So I think with time, what's happening is the companies, which are not generating good earnings, good profits, are the stocks to correct that is happening right now, and very correctly pointed out by CP as well. And I think in an overall period, in a longer period, I feel the tech space is the future of any economy for that matter. If you talk about US, if you talk about India, so in a longer period, I feel the technology sector in US as well as India is bound to perform. A little bit of correction will happen because they gave extrapolated returns in the past 1.5 years. And in fact, if you look at US tech, if you look at NASDAQ, or if you look at some of the indices like a Russell 1000 or a Russell 2000, you will see that they've outperformed even in the last 10 years for that matter, right? So a time correction is bound to happen. Stocks or companies which are not performing well are bound to come down. But overall, I feel this is a very good space to invest into, especially the technology sector. I am more bullish towards the US technology sector, but even if you look at the globe, if you look at countries like China, you look at Europe, some of the tech companies are doing well there also. But if I look at it from a longer perspective, in the next 5 years, I don't find any problem in the technology space internationally in the global investments part.
So Abhishek, there's another question on US markets. What expectations are there from the US markets in 2022? What is going to be the impact of Fed rate hike? How high are we looking at interest rates and tapering on US markets? And what is going to be the impact on Indian markets as well?
Thanks, Shalini. So, whenever a Fed rate hike happens, so basically the logic behind that is that, a rate hike in US yields ends, it leads to a yield increase in the US markets. So money starts flowing from the emerging markets back to the global markets. The logic is very simple. If the FIIs and foreign investors have invested into India, when the rates were close to zero or less, let's say a quarter of rates, and you put a hedging cost on top of that at 4%, Indian yields still give them a additional percentage, right? So if US starts increasing, and if you also include hedging costs into it, the emerging markets, and let's talk about India for that matter, uh, the yields in India do not, attract too many FIIs and FPIs, because the hedging costs will, erode most of the returns for them, and it's better for them to invest in their own country rather than investing into emerging countries. So generally, the FII flows out. Uh, what we've seen in Jeremy Powell's statement the other day, the expectation is that they might increase rate almost every Fed meeting that can happen, that will happen this year. So, the markets are expecting about about four rate hikes of a quarter. They've indicated that in March they might be starting a rate hike cycle. So, if that rate hike happens, a knee-jerk reaction is bound to happen. But that's not the only factor that we have to look at. So when we look at the Indian markets, that's one factor. Then, as the speakers pointed out, the earnings of the Indian companies are really coming really well, right? It's actually very surprising to see some of the balance sheets and some of the earnings of some of the companies, which are in fact better than 2019 and 20 also in some cases. So if the earnings are increasing, that's a positive sign for the Indian markets. The EPS growth is increasing for some of the companies. So there are a lot of factors that we have to look at, but I feel that the Fed rate hikes will act as a knee-jerk reaction. We have seen that in the past 2 months, December, when they decided to taper and increase the tapering by about doubling their tapering that they announced in December. And in January, again, this month, when he announced that they might look at a rate hike in March. And he also pointed out that with the labor data coming in, that he has a lot of scope to increase rate hikes, which I think impacted negatively to the markets, and we saw the markets plummeting at the same time. So rate hikes will have a knee-jerk reaction, but these are buying opportunities which we look at. From my perspective, I look at it as a buying opportunity, both in the international market as well as the Indian markets. And the other factors are very supportive of the Indian economy. It's growing at a steady pace. The earnings are pretty nice. It's pretty good, in fact. So I feel all the corrections and the knee-jerk reactions that happen because of the Fed hike should be treated as a buying opportunity.
Thank you, Abhishek. So I think we have Niranjan back online. Niranjan, can I just have a response from you in order to proceed with the question from your end? Niranjan? Niranjan, I'm not able to hear you. I can see you in the list of participants. Can I please have a response from you? There's a question from an investor for you.
I think, Shalini, we have multiple questions from the investors in the chat box. So
Correct. Niranjan, I think
he's having some connectivity issue.
Right, he's trying to join back in. So meanwhile, I'll take the rest of the questions.
Hello,
So,
can you hear me?
yes, Niranjan. Finally, we
Yeah.
have you back online.
Yeah, apologies for the bad connection.
No problem, understandable, Niranjan. So, Niranjan, I'm going to ask you some of the questions that our investors have put forward on the global aspect. Can you tell us what to expect from the technology sector globally this year?
So broadly, what's happening in US and specific to US tech, would like to comment. We have seen Fed rate uh, hikes are expected, widely expected. In fact, instead of four rate hikes, there are talks that the rate hikes could be more aggressive. So usually what will happen is some of the tech stocks where the valuations have been on a higher side definitely see some volatility and would see some correction. At the same time, one should be mindful of why the Fed is increasing. There are two reasons. One is inflation, and second is economy is also coming on track. The unemployment numbers are at decade low at pre-COVID levels. So overall growth scenario is also healthy, while inflation is a major worry. So broadly for tech stock, actually underlying growth remains to be very, very strong. The concern would be only on the valuation side. So till the time, the valuations become reasonable, I think the volatility will be there. Once this year's earning catch up with the price to earning ratios and other ratios for these tech stocks, I think so it would be quite stable. From a long-term perspective, 3 to 5 years, I think so next 1 year would be an opportune time for a lot of people to invest in tech stocks. There could be heightened volatility, so there could be drawdowns of 10, 20%, or even more. These could be definitely used as buying opportunities into the stock because in last 2 3 years that most technology stocks have seen a secular I think so this year would be year for accumulation on the tech side.
Thank you, Niranjan. So, key takeaway, there were higher valuations on the tech space. FII's Fed is typically increasing rates because of inflation as well as the economy coming back on track. The next 1 year, we're looking at some sort of a volatility in the space, and every correction should be used as an investment opportunity over here.
Absolutely.
I'm going to put up the further questions which have been asked by our investor. So, Mr. Prashant Verma has put up a question for Amey. Amey?
Yeah, I can.
Yes. So, Amey, your first question from Prashant is how can the profit percentage be increased in investment in year 2022?
Sorry, I did not get the question.
Right. So,
Profit
the question
percent.
is how can the profits be increased in our investments?
You're saying underlying for the underlying companies?
Right, for this year.
Okay, so for this year, I think one delta that can come is from a softening of commodity prices. As you would have seen last year, there were issues with respect to because of COVID. There were a lot of problems with respect to availability of raw material or the prices of raw material. There are lots of I think lag that was coming, and you would have seen in case of say car cheap availability was a problem or the cost was high. We have also seen elevated levels of commodity prices in 2021, and a lot of companies have responded by taking a increase in pricing. So, for example, paint companies would have taken a 15 to 20% increase in pricing. And normally, what we see whenever commodity prices sort of moderate, we don't see that kind of a reduction in the prices that they have increased. So that will be one driver for profitability improvement, assuming commodity prices cool off. At this point, at least crude is not cooling off, and that will obviously have an impact on inflation. But I think that will be a key driver. And obviously, if demand comes back, because demand is still not that strong, we are seeing a pickup in demand, but I think we are still not full blown out kind of a recovery. So if demand comes back, then you will obviously see a top line growing, and then you will have operating leverage also coming into the picture. So that is the one way we can expect improvement in profitability for a large percentage of companies in the listed space. And lending side, which is obviously has no correlation with respect to commodity prices and all. What we are going to see is that the provisioning requirement for banks or as well as NBFC and HFCs is going to be significantly lower. In fact, it could be easily 30 to 40% lower compared to what we saw in last 2 years. So that will be that for them, it will be a driver of profitability.
Thank you, Amey. Manish, the second question is for you. This is by Mr. Sri Prakash Agarwal, a senior investor. He's asking about the percentage allocation of different classes that should exist, ideally for a senior citizen.
Yeah, I think it's a very subjective question actually, and I think the best answer would be the advisor whom you're having a daily interaction. Why I'm saying it would be a more of a subjective, because the advisor can give you a much better picture. He can understand how much percentage you have invested in equity, debt, etc. Based on that, the advisor can take a call. Plus, if you have any goals which you are looking at in the coming years, let's say if you're planning, okay, next 3 years, I wanted to buy a car, and it's a short term kind of a goal, or a kind of medium, not a very. So if you're looking 3 years kind of a zone, then you should not be very high on equities. Maybe you should have a uh, 60-40 kind of a exposure, 60% in debt and 40% can be in equity, right? So based on your goal, or if you're looking, let's say after 10 years, I wanted to buy a house, I have a good horizon. If that's the goal, then you can slightly go higher on the equity side and can have a lower debt. So it's a very subjective question. What should be the exact equity debt allocation which you should be having? But ideally, I would say that if you are somewhere in that, let's say a person is in the range of, let's say 25, 30 years around, I think a good 80-20%, that is 80% in equity and 20% debt. You move on to 40, 45, I think then the allocation can change to, let's say 60% equity, 40% debt. And as you closer to 60, maybe the allocation towards equity can be reduced to 30-40%, and equity can be around 60-70%. Having said that, like I said, it's subjective, because if you look at Warren Buffett and he says that, okay, I'm so and so, even at the age of 80, he used to clearly say that, I'm extremely bullish on equity. Still, my 100% of the portfolio would be in equity. So, yes, it depends on the person's risk appetite, his goals, and his expectations of returns in the coming years. So, yeah.
Thanks, Manish. Niranjan, the next question is for you. Mr. Vikas Luthra asks that there has been recent correction in the US space, and FIIs are seeing selling from India and DIIs are buying over here. Does this signal anything for retail investors?
Yeah. So this typically happens, when the Fed sneezes. So we have seen this happening in 2013 as well. The good news is India is, as far as India is concerned, we are in a much better shape compared to the past when Fed has increased rates. So I think so. Retail uh, need not worry about the Fed rate hikes much in this cycle. I think so. India is much more robust in terms of its macro to handle the situation. What will be important is how the domestic economy shapes up, how the earning growth happens, and which segment of the market you are invested. So if investors avoid chasing the past winners, because we have seen commodity stocks doing well, some cyclical stocks doing well. I think so. Avoiding them, these kind of sectors. If retail investors are avoiding these sectors, they should be fine. Otherwise, then need not be any worry as far as Indian investors are concerned. On the US stock, as I mentioned, largely on the technology side, the correction has been. If you see the other side of the story, US value stocks are doing well. So financial stocks, healthcare stocks are, which were in the value zone, were doing well. So if someone is well diversified as far as US markets are concerned, I think so they need not worry. Next 1 year could be a good accumulation phase for investors looking to invest in US, whether it is tech stock, any stocks for that matter.
All right, Niranjan. Amey, the next question is for you, perhaps. Should we invest in LIC in a big way in the IPO?
No, let the pricing come in. I think let's wait what kind of a valuation that government is trying to bring for LIC. And one observation that we have is that in a IPO space, it is things are still overheated. I think it has cooled off a bit till I think Paytm ITM IPO. I think things were quite euphoric. And on the other hand, in the listed space, we have lots of companies which were trading at a very attractive valuation. So our philosophy or our way of investing is that we have not participated too much into IPO. In fact, we have nibbled on what are the available in the listed space where we know what kind of a management history, management track record, financial performance is there. So I think let the valuations of LIC come out in the public. Then I think probably we can take a better informed view on the IPO.
Sure. Abhishek, next question for you. Since the markets are down, should we look at investment in mutual funds or stocks? Abhishek?
Yes, Shalini, that's a tricky question for me. Uh, See, it all depends on your risk appetite again. Stocks, at the end of it, mutual fund, the fund managers are also taking stock decisions only in equity. So it's more or less what you're doing, right? So if you let's say like a fund manager, like his experience, like his way of managing that mutual fund, uh, then you can go for mutual funds. Otherwise, you want to build a stock portfolio, you can build a stock portfolio as well. Stock portfolios, when you build with an advice, are a little more aggressive. They are a little more higher on returns uh, and on risk as well. So it completely depends on your risk appetite. If you're willing to take a higher risk, and you'll be rewarded higher as well, you can look at stocks. Otherwise, I think mutual funds are a safer way to get into it, because there's a fund manager, there is a whole team of the mutual fund company who is managing your investments.
Amey, what do you expect from the automobile sector this year when petrol and diesel rates are increasing and government is promoting electric vehicles?
So I think EV transition will continue, and we are already seeing a fair bit of a pickup in two-wheeler EV side. Four-wheeler EV side is picking up, but it is picking up relatively gradually. But that transition will definitely continue. I think customers as they start using EV vis-a-vis ICE, I think you will see a difference in performance, and there are lots of other benefits. So I think that will continue. Uh, Auto sector will should see a better demand this year. Last year has been completely impacted because of chip shortage, where there was a fair bit of a demand, but because of chip shortage, auto players were not able to fulfill that demand. The problem on two-wheeler is will continue simply because the bottom of the pyramid segment is still struggling, and that is where you are seeing a demand still remaining weak. So if we see improvement in that segment, I think then two-wheeler also can come back. But I think four-wheeler side, I think there is a fair bit of a expectation that things should be better this year compared to last year.
Manish, next question is for you. So, Preeti Devakar has to ask, what investment strategy is suggested to a client with a conservative profile but who is not happy with debt mutual fund returns?
Okay. Yeah. Yeah, I think yes.
The investors
Ve-
मिलते हैं.
yeah, very honest opinion, I guess कि हाँ नहीं नहीं पसंद है, I guess नहीं हो रहा है return. Yeah, true. But I think see, there were a period when debt as a category was giving a good return. Maybe 1.5 years back, you would have seen debt funds giving you almost close to 12-14% return. That was a very conducive environment for debt funds to give you a return. Why? Because point number one, interest rates were coming down. Right? Point number two, you had very easy liquidity conditions in the system. Point number three, you had a RBI which was very accommodative in terms of stance. And point number four was inflation was in a better range, which was a tolerance limit for RBI. So they were comfortable. Right? Now what is happening? All 4 points, if I repeat again, your liquidity condition is slowly getting sucked out. RBI is now changing stance, thinking for a hike in rates. Plus inflation also, if you look at, is kind of slowly moving up. So the conducive environment which you had for debt returns in the last 1.5 years is now all of a sudden is slightly becoming volatile. And that's why I completely relate to the investor that yes, debt mutual funds are slightly volatile in the last 5 6 months with the rates going up. So see, what I can recommend over here is that why don't you, as an investor, if you're comfortable with taking a little bit of risk, and that's why you've mentioned that you are a conservative investor, right? So, if you are okay to take a conservative equity exposure, what I mean by equity exposure is that there are certain category of schemes which takes very less or very low level of equity exposure. Like there is a conservative hybrid categories, right? Which will take a 15 or a 20% equity exposure and rest is 80% is debt. So the blended return of having 50-20% in equity and 80% debt would be slightly much better compared to having a pure debt fund if you have a horizon of more than 3 years. If you wanted to take uh, uh, um, your risk appetite slightly a notch higher, then you have funds like equity savings fund as a category, where the equity level can range between 15 to 50%. So you will have roughly 30-35% in equity and rest in debt. If you are okay saying that okay, I can take a little bit more risk, then you can elevate yourself to a category called as dynamic asset allocation fund, or we call it as balanced advantage fund, where the average equity ideally would be around 45-50% and 45-50% would be in debt. So I think if you are looking or exploring for options to create or have slightly much better returns, then I think all these combination which I have highlighted, conservative equity, equity savings fund as a category, balance advantage fund, can give you a blended returns which is slightly better. Thank you.
Great, Manish. So, Preeti, balanced advantage funds, asset allocation approach is the answer. Uh, Next question, Mr. S.K. Sethi has to ask, and I'm going to put this to you, Amey. When can we see anything in mutual fund space which is focused towards insurances?
So I think we have a banking fund that invest heavily in insurance fund. So our own banking fund has almost 15% of AUM is invested in insurance. That is life as well as general. So I think that is to start with, that is a good way of investing in insurance sector. I think just to highlight that point, in fact, insurance sector also has been a one sector which has gone through a lot of time correction. So you look at stocks like say HDFC Life or ICICI Lombard, they have done absolutely nothing for almost now 2 years. So clearly that space is also looking quite attractive. Although valuations were expensive, that's why probably there was a fair bit of a time correction. But business is trending very well. And clearly one can take exposure by banking fund at this point.
All right. And CP, my final question will be towards you. Prashasti wishes to ask what stock markets can expect from budget 2022.
Well, I would say budgets are relevant to look at the balance sheet of the government. But from a market perspective, I think so. For example, the indirect tax is more now in GST. On a direct tax perspective, well, the highest bracket tax people are at 42%, which is more like a higher number on a relative basis globally. So you can't do much there. Uh, from a low tax perspective, maybe they'll add some bits of more tax saving instruments or amount in housing and all that they can do, but and they will probably most likely they should focus on demand creation in the economy, which means that spend more in capex and budget more for capex. However, the room for maneuver in the when you look at the numbers is not very high. You can at max play with 50,000 to 1 lakh crore at max here and there. So it's not a very large number that the government can play this year. But still, I think as usual. I think the important point for this government is that they've been very disciplined. They have spent wherever it is required and not done unusual or stimulus expenses or free money. Those kind of things this government has avoided. I give them a full 100% marks of credit for that. I think if they continue to be disciplined, if they focus on specific areas where they want to, for example, the production linked incentives, though they've announced it outside the budget, ultimately it's budget expense, which they will be providing to corporate India for the next 5 years, 6 years. So I think they are already taken all the steps that it'll be more like a mission statement rather than anything specific to look forward from the budget.
Well said. So we've exceeded our time frame by a very large amount. I'm going to have to close the question and answer round. Investors, I'll request you to have a look at the feedback form and please put in your feedback and expectations from our next sessions. I'll be closing off the session with the vote of thanks. Thank you so much, Amey, CP, Niranjan, and Manish for joining us today. You've been very kind to take out time on a Saturday morning and give to our investors. We look forward to conducting many more sessions with you on different topics on coming Saturdays. And thank you so much for the relationship team as well. Asim, Ravi, Amit, and Anurag. Extremely kind in terms of the coordination and efforts put in to organize this session for our investors. Thank you. Stay safe. Signing off. Bye.
Thank you.
Thank you.